Hello everybody. Would you be so kind and tell me if you can hear me properly? Please let me know so we can begin our live stream today. Sounds great. Wonderful. Thank you very much for your answer. So today should be a very, very easy one compared to the live streams we have had so far, where we delve into really complicated stuff about Elliott waves and counting and interpreting and forecasting and so forth. Today we're going to discuss a very simple strategy, one that I posted on Sunday, the first one of a series of 7 strategies that have stood the test of time. These are phenomenal strategies that will really enrich your trading tool, and applied properly, you will benefit immensely from them. So the strategy that we're discussing today is gaps combined with trend lines. So to begin with, I'm going to expand a little bit your knowledge of gaps. Okay, let's begin with what are gaps. These are the things that we're going to cover today. And what are gaps, the myth, where do they appear, and a little bit of context for you so you can be better prepared to identifying gaps. So the very first thing is, what are gaps? Gaps are very simply an area in a price chart where no trade has taken place. So let's say that you are in an uptrend. Prices are moving high like this and like this and like this, and suddenly we see a space, an empty space there where no trade takes place. These are gaps. So the thing that everybody knows about gaps, or at least everybody believes about gaps, is that gaps are always filled, meaning that if you see, for instance, a situation in which a gap appears, well, that gap should be filled, meaning that trading should appear or cover that area completely before continue moving in the direction of the gap, or even moving in the opposite direction. The point is that those gaps typically need to be filled. Well, the sad story is that that is not true. Not all gaps are filled. In fact, few gaps are filled. And that is because where gaps appear. Okay, so gaps appear in the context of trend. Typically, when, let's talk about a bullish gap, okay? The same thing applies for bullish or bearish. It doesn't make any difference. But let's talk about bullish gaps to make it simple. So let's say that there was a structure. Let's assume that there was a downtrend, let's say, okay? And this downtrend ended. So now a new trend begins. So when that new trend begins, a gap may appear. And that gap may or may not be filled. In other words, prices may retrace, may even fill a portion of the gap, not necessarily the entirety of the gap. But typically, let's say that this is the situation where this structure to the downside is complete. So now we had a gap there. And well, now what can happen is that if the trend continues moving in, that's not the writing tool I needed. If the trend continues moving, then another gap may appear. So now, these different places where gaps appear are typically in the beginning of a new trend, right in the middle, and also at the end. In other words, let's say that the trend here, the uptrend, is about to end, and then we see something like that. We see another gap. So those places, those different places where gap tend to appear, this is not an unintended gap, those places give name to the different types of gaps. So this one, for instance, the one that appears in the beginning of structure right after the opposite direction has been complete. Let's say that this was a correction to the downside. Let's say that it was a full trend, a full impulsive wave that ended to the downside, and now a new trend begins. Right in the beginning, we see something that we call the breakaway gap. So basically, you will find three types of gaps. The one that are called breakaway gap, the one in the middle of the trend that is typically called the acceleration gap, or also runaway gap. And then there is the last gap in the trend, which is called the exhaustion gap. The exhaustion gap appears right before the trend, in this case the uptrend, ends. So now, what is the context of this? Okay, so you all know that a trend, from the Elliott wave perspective, is determined by 5 waves. So, for instance, we call this a wave 1, wave 2, we label this as wave 3, then wave 4, and finally wave 5. So now, we know that each one of these waves typically would subdivide in 5 waves. Okay, so wave 1 will be the exact same picture as the entire thing. In other words, wave 1 will subdivide in 5 waves. Then wave 3 will also subdivide in 5 waves. And wave 5 also will subdivide in 5 waves. Now, what you will notice here is that all of these gaps would tend to appear on the third wave of their internal subdivisions, meaning that the breakaway gap, the first gap that appears in the beginning of a trend, would tend to appear on the third wave of wave 1. The acceleration gap, or the runaway gap, would tend to appear in the third wave of the runaway gap, of the third wave. And the exhaustion gap will tend to appear on the third wave of the fifth wave. So those are obviously no rules, but the thing is that why do gaps occur? Well, they happen because the market is in a hurry to make progress in that particular direction. So in this case, the market, let's say, is completed the decline, so it's really much in a hurry to recover, and then it gaps. But we know that third waves are precisely the waves where prices tend to accomplish the most in the fastest possible way. So when prices move the fastest, the strongest, is typically on the third wave. And so sometimes, to accomplish even more faster, the market gaps. So it makes sense that that happens on the third wave of any of the impulsive waves. That tells you, and that explains why not all the gaps are filled. I know it sounds like I'm saying something completely against what the mainstream says. Everybody knows, every trader knows that gaps are always filled. Well, they aren't. And for instance, the case of the gap that occurs on the first wave, which we call the breakaway gap, well, that gap may be filled or may not, because we know that wave 2 will tend to retrace, let's say, 50 to 62% of the distance traveled by wave 1. So if it travels, let's say, 62% or something like that, there is a great likelihood that it may fill at least part of the breakaway gap. But the acceleration gap, or the runaway gap, is practically never filled, at least not immediately. And the reason is because wave 4 retrace 38% the distance traveled by wave 3. And we know that the runaway gap typically happens on the third wave of the third wave, which means in the fastest possible wave. And so that will be the middle of the entire structure, typically. Okay, typically the exact middle of the entire structure is the one that is vertical, the one that has the more speed, the more power. And so the 38% doesn't get to that middle, because that happened probably at the 50%, or between the 50% and the 62%, or something in that, about those levels. So the 38% would probably not fill the gap. Now, it is possible that later on, let me move the chart. It is possible that later on, when the whole structure is complete, and now we have the correction to the downside that, again, would retrace between 50 to 62%, it is possible that by that time, the gap is finally filled. But it won't be filled immediately, as people typically expect, right? Then the exhaustion gap. Well, when you see those 3 gaps and you see those 5 waves, the exhaustion gap is like the last attempt for prices to continue moving in that particular direction. They are really great in terms of trading and in terms of analysis, because if we are able to count those 5 waves, if those 5 waves are clear, and then we see a gap to the upside in an uptrend, we know that this is the end. We know that there is a change, there is a reversal. Whether that reversal is going to be a correction or a change in trend is a different matter, but we know that the upside is limited. Therefore, we can take position to the downside, or accumulate position to the downside, because this, as a third gap on the 5th wave, is really telling. It's basically warning us that the end is near. Okay, so now that you have the entire explanation of gaps, where, let me move this so we can see, you know what gaps are, you know the myth and why, you know where they appear, the beginning of the trend, the middle of the trend, or the end of the trend. Call them breakaway gaps, runaway gaps, or acceleration gap. They also call them measuring gaps, the acceleration gaps. The reason is because typically you can't measure the entire thing, and this acceleration gap will occur exactly in the middle. So that's why they call it the measuring gap, because when it happens, you can actually make a projection that the rest of the trend will be similar to the beginning. And now you have the context. The context is where they appear in terms of the context of the Elliott wave principle. So now you got it all. Now, right after I posted the video on gaps on this particular technique, I noticed the next day that we had a gap, one that allowed us to show you in practical terms, because one of the typical questions that I get is that, can this be applied for day trading? And the answer is yes, indeed. So allow me for a second, please. Siri, could you please? You can hear this. I'm sorry. So this allows us to give you a very specific example on a 15-minute chart. You can see here we have a 15-minute chart and the price gapped. You can see here the closing of this bar and the opening of the next bar right here. And you can see the empty space right there, right? The empty space would be seen bigger if this recovery would have been so deep. But still, you can see the empty space. The important thing is that you see the closing of this bar with the opening of the next bar, and you can see the big gap there. So what's the next step? Well, the next step is to use those trend lines. If that trend line, if that gap gapped precisely below that trend line, then we can see that we have the application of that strategy. And that's exactly what happened here. You can see how prices gap beyond that trend line, right? And once they gap, of course, they went to retest the trend line. They retested it several times. They kissed the trend line many times before continuing. Now, what is the way that we apply this? Well, we know from the video that the low of this should be penetrated, and our strategy says that we sell 1 pip below the low of the bar that gapped. This was the bar that gapped. So what happened here? The bar gapped, or prices gapped. They recovered. We put our sell stop right here, 1 pip below this bar. Okay, the thing recovered. When they came back down, they filled us. Now, when we were filled, at that point, we needed to put a protective stop. So where would that protective stop go? Well, that protective stop goes precisely at the top of the bar that gapped, right? So this is the initial stop. Thereafter, obviously, you can trail the stop. You can use the different sizing, as we have been suggesting in different videos where we speak about the position sizing. But the beginning is you put the stop right there. So now we are filled. Prices start going in our direction. Prices recover again, but don't come even close to the gap. In this particular case, once the new low is penetrated, we can now afford to lower the stop, or trail that stop to this pivot high, or even this one. Or in this particular case, because we have the low penetrated here, we can even lower it to this level. And the point is, we want to eliminate risk as soon as possible. But you do know the magic of trading in threes. So you know that video where I talk about position sizing, or I call it size matters. So I suggest you watch that video so you can see how we manage positions that way and how we eliminate risk rapidly using those type of of position sizing. And you can see the trade worked beautifully, and this happens on a 15-minute chart. So now let me read your questions, because I can see several questions here. First one is this something I can use in stocks too, or is it only for Forex? The gaps appear everywhere. Now, I should say that additionally to the 3 types of gaps that I just gave you, there are also gaps that are called common gaps. Those common gaps are the gaps that are not significant, like the ones I showed you in the context that I showed you. So common gaps are a lot more common in stocks, but the type of gaps that we have discussed appear on absolutely every trading asset. It doesn't really matter the security that you prefer to trade. You will eventually find gaps there. So it works for Forex, it works for cryptos, it works for futures, it works for stocks, it works for any trading asset that you may prefer trading. All right, so let's see. The next one is, can we assume the context same ABC correctives as well? Well, it doesn't matter if what happened was an ABC. Let's put it this way, okay? Let's try that specific scenario that you are talking. Let's say that trend was up, okay? Trend had been up for whatever amount of time, and now we have an A, B, C. Well, what matters now is that the next trend will be treated analytically exactly the same way that I showed you before. Because what matters is that the structure to the downside is complete. So in this case, we have an ABC complete. Okay, well, now we can expect a wave 1 here that probably gaps because it wants to complete the resumption of the trend faster. So it may still do exactly the same way that I showed you before, regardless this was an ABC or a downtrend. It really doesn't matter, doesn't make a difference. I hope that answered your question. What about gaps that form often in the opening? Well, the gaps that form in the opening are precisely, typically, those gaps that are called common gaps. Okay, those common gaps are precisely the gaps that form because of the difference between the closing of the previous day and the closing and the opening of the next day may be different. So in those cases, unless the whole thing is part of the trend as you have been analyzing it, then it wouldn't make any sense to trade those gaps or treat them exactly as we are discussing. Now, you could apply the technique to those gaps as well. It is possible because the fact is that typically when prices gap, it's because they are in a hurry to go in that direction. Now, sometimes prices gap in a particular direction and then they really turn around. But that is the reason why we use a very tight stop. As a very tight stop, I mean, like in this case, let me go back there. Basically, we put the stop at the top of the bar that gapped. This was the bar that gapped, right? So we put the stop right here. So we typically are talking about 1 bar stop, which is not something large, not something that we can, unless we're talking about a monthly or weekly chart. If we do this on a daily chart, it will be okay. Now, I should say also something that actually talking about monthly charts and weekly charts. When prices gap in those time frames, they are not very typical, but when they do, they are very, very significant. right? Because you can see that the gap in those time frames are the result of a real necessity of the market to move in that direction. Otherwise, it wouldn't have gap for a month, right? Or for a week. So, but you can use the daily chart gaps to trade this type of setup, or even, intraday charts, and they still work. It's a very, very good technique that has been used for many, many years successfully. It's one of those strategies that has stood the test of time. Can breakaway gaps appear in wave A? Yes, indeed. Because, that's a wonderful question, by the way. Okay, so let's say wave A's of what? Let's say that is a wave A of zigzag. All right, let's begin there. So we have a zigzag, looks like this. Let's say that the correction is to the downside, okay, just to keep the whole bullish perspective. So this zigzag has a particular formula. Remember, is a 5, 3, 5. In other words, wave A, in this case, will have 5 legs. Wave B will have 3 legs, and wave C, right here, will have also 5 legs. So again, the gaps may appear exactly in the same way that I showed you. You could have a breakaway gap on the first leg of the A. It could even have a runaway gap on the third wave of the A. And it could also have an exhaustion gap on the fifth wave of the A. It could also be that it only takes it only gaps right in the middle of the A, giving basically a breakaway gap of the entire thing, but it's going to be a breakaway gap in terms of the first gap that appears in the first move of the structure that had changed direction. Does it make sense? And the same thing, by the way, would apply to wave C. A market could gap in the first wave of wave C, could gap on the third wave of wave C, and on the fifth wave of wave C. Now, before I actually take another question, let me show you something that is interesting about gaps. Well, not that what I have shown you now is not interesting, right? All of those things, I think, are very interesting. But there are situations where we have, let's say we have a 1, 2, 3, 4, and now we have an exhaustion gap, right? Now, it happens that this exhaustion gap is, as you know, on the fifth wave, but is followed precisely by a gap on the wave A of the next. So it does something like that, right? And let's say wave B and C, just to keep the structure complete. But you can see now that we have two gaps there. This gap right here and this gap right here. And worse yet, we have this structure completely isolated, completely separated from the rest of the price structure. So to this type of formations, we call them island reversals. These are island reversals. They are very, 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 very good things to trade, simply because, well, you're basically having two confirmations of a change in trend, an exhaustion gap and a breakaway gap. So those two gaps, let's say, together form the island. The island is like an island surrounded by water, let's say. So here is the water, all this is the water, and here is your island, right? All right, so I hope that answers your question about, is it possible that breakaway gaps appear in wave A's? Indeed, it is possible. And when they do, right after an exhaustion gap, well, what you get is precisely an island reversal. Okay, hi, I'm new to trading and I like your channel. Thank you very much. I'm so happy to hear that. I was wondering if you are scalping 3, 5, 15 minutes, how far back do you go to analyze? 1 week, or is it too much? If you are scalping a 3-minute chart, what you want to really be aware of is the trend in a time frame that is 5 times larger than your time frame. In other words, if you are scalping off a 3-minute chart, you want to be looking at the trend in a 15-minute chart. If you are scalping in a 15-minute chart, then you want to be looking at a trend in a chart 5 times larger than the 15-minute chart. Okay, so to try to let's say, to scalp off a 3-minute chart and going into a daily chart or a weekly chart for context doesn't really make a lot of sense. You do want to have context. You do want to always keep track on the prevailing trend, but you want to do so on a time frame that is no longer than 5 times. Of course, that is not an exact figure. This is something that has been tested not only by me, but by many, many, many analysts. And we have all concluded that 5 times is the ideal. It's possible to have 6 times or even 4, and it's okay. For instance, you could be trading off a 15-minute chart and looking at an hourly chart, and it's okay. But ideally, you want to have the 5 times more. Hope that answers your question. Does it matter where the gap appears? Well, in terms of the strategy that we are discussing, it really doesn't matter if it is a breakaway gap, if it is a runaway gap, if it is an exhaustion gap, or even if it is a common gap, because we wouldn't know, right? So in those terms, it doesn't really matter where the gaps appear. Okay, what it would matter is that you put your trend line and the price gapped above, or not above, let's say beyond the trend line. Okay, that is what really matters. Great explanation, thank you. Well, thank you for the question. Actually, you give me the opportunity to to answer you. So thank you for participating and giving me your feedback. Is there a best time frame on the chart to differentiate and identify the correct type of gaps, like something we shouldn't consider common gap as a breakaway gap? No, there isn't. There isn't. Because all these things truly are, let's say, applicable in all time frames. Because as I have explained before, the Elliott wave explanation or interpretation of markets is fractal. So the exact same thing that occurs in a 1-minute chart occurs in a 1-day chart, in a 1-week chart, in a 1-month chart. Now, having said that, I mean, let's say that you are trading off a 30-second chart. That's possible. I don't think it's very recommendable, but it is possible. And let's say that the price gap there over a trend line and you found your setup there, you can use it exactly the same way. All right? Exactly the same way. And in those particular cases where you're going to have very, very limited risk, the strategy can be applied to any time frame. Now, having said that, what I explained before about the gaps appearing on a weekly chart or a monthly chart is a matter of significance, because when a gap appears, let's say on a 3-minute chart, it could be really a common gap. But when the gap appears on a monthly chart, rarely is a common gap, right? Rarely, or perhaps never. I never thought about that, but I would think logic tells me it's never a common gap. So whenever I see a gap appearing on a monthly chart or a weekly chart, I take those gaps seriously, because likely those gaps are either a breakaway gap, a runaway gap, or an exhaustion gap. So we have to then go into context and see where are they, and then trade accordingly. I hope that answers your question. All right, so I believe I covered everything about the gap strategy. If you have more questions or comments, please leave them under the video, and then I'll try to answer you as soon as I see them. And if you have more questions right now that you want me to address regarding this technique, I'll be more than happy to do so. Otherwise, then I will thank you so much for being with me a part of your afternoon, or at least this is my afternoon, probably your morning somewhere, but it's my afternoon here. So not seeing more questions, I'll say thank you so much, guys. I'll talk to you next Wednesday, when we will discuss the next strategy, the next of the 7 strategies that stood the test of time. Okay, so I'll be seeing you there. Thank you so much. Bye-bye.